Head of Macro Strategy at Desjardins, and he joins us here in studio. Nice to see you.
My pleasure.
So, what do you think is going to happen to interest rates?
I think in Canada, we have to expect that the next move is going to be a cut. It's not going to come until 2024, but the bank is done raising interest rates. If you look at the measures of the economy that they track, whether it's GDP, whether it is inflation, all of these things tend to be moving in the right direction, or are expected to move in the right direction with a bit of a lag. That likely suggests that the bank is going to eschew any further rate hikes, even if there's a little bit of a resurgence in GDP in Q4, let's say, from the stagnation. Further out, though, the wave of mortgage renewals that is coming in terms of 2024, but really 2025 and 2026, means that the bank needs to get rates lower. Because if they don't, 2025 and 2026 are going to be extremely harsh years. And that means they need to probably head into those years with rates already a little bit lower than they are today. So we have rate cuts beginning in the second quarter of next year, which is earlier, I know, than market participants believe and most of Bay Street believes at this point.
The number that was floating around this week in the headlines was something like 60% of the mortgage market's going to be going through the renewal process over the next 3 years. Does that match up with your own expectations?
Yeah, that's typical, right? I mean, we have these 5-year mortgage.
It's the market. Yeah,
it's a 5-year renewal cycle in this country typically. So 20% in any given year should be renewing. But keep in mind, 2020 and 2021, the housing market in Canada was booming. So there were a lot of mortgages taken out. So if you fast forward 5 years from then, 2025 and 2026, you'll actually see some an outsized number of mortgages renewing. So it'll actually be probably a little bit greater than 60%, I'd say, over the next 3 years.
So what does the rate cut process look like to you if they do start next year? But obviously, there's been this constant dialogue around the need for higher for longer to address some of the other issues like inflation.
I think higher for longer is a signaling tool. The first order of business is still getting inflation under control.
Yeah.
I mean, to be able to cut rates, we have to see probably inflation below 3%. And I'd probably say we'd need to see unemployment above 6%. So getting inflation under control is the first order of business. But then they can start to reduce rates. This is not anywhere near the neutral rate. Even if the bank is wrong about the neutral rate being 2.5%, it's probably not that much higher. It might be 3% or something like that. So they can still reduce rates from 5% without being stimulative in terms of the setting of monetary policy.
Can I throw a couple extra numbers in there?
Yeah.
So let's talk about I think inflation right now is around 3.8%.
Yep.
And so the target levels from these central banks has been 2%. You're saying if we get below 3%, all of a sudden maybe there's wiggle room for the Bank of Canada to start cutting rates, even if that's not the target level for what these central bankers have been hoping for?
Well, two things on that point. Well, central bankers are always forward-looking. So they're setting monetary policy not based on the data today, but where they think the data will be 6 or 12 months from then. But also in Canada, we have this weird way of calculating CPI shelter costs where we take into account mortgage interest costs. So the Bank of Canada's own rate hikes actually feed into the inflationary numbers.
Right.
So if you subtract those, which you need to do when you're trying to think about inflation or underlying inflationary pressures, I think something sub 3% is really actually consistent with 2% inflation, or actually maybe even a little bit less than 2% inflation, and you can start talking about cuts, particularly if, as I said, the labor market is weaker by then, an unemployment rate above 6%.
Yeah, I guess if you thought sticker shock was prevalent at the grocery store, you look at what's happening with variable rate mortgage payments right now, to your point about the inflationary effects there.
And it's only going to get worse.
Okay, well, then let's talk about the jobs market, because you talked about if you see the unemployment rate, 6 or more, are we, what were we, like 5.5%?
Yeah, 5.5%.
And how do you think in the interim, like what's the jobs market going to look like in this country? How concerned are you about what the employment picture is going to look like? Because some people get concerned that when you start to see rate cuts, yes, there's the mortgage complication on that, which might feed into it, but it's like, you need to cut rates because things are really deteriorating for the economy.
I'm concerned about it from two angles. One is that we're introducing a lot of new people into the economy. can the economy absorb all those people and put them to work every month? So far, even though we've been adding 40,000 jobs, 60,000 jobs even, the labor market has actually been loosening because we've been adding 100,000 people 15 years or older in some months.
Just the number of new Canadians, but not necessarily an improving employment picture, plays into unemployment.
Yeah, so we've been adding so much labor supply. I mean, last year, I'll just give you an anecdote. Every single company I spoke to, their number one or number two issue was labor shortages. Now, when I talk to companies, labor shortages are still maybe an issue, but they're far further down the list because we've added so many people and those jobs are getting filled. The second point is that the economy is weakening. Interest rates do a lot of work in this country because we're on this 5-year mortgage cycle and because we have so much household debt outstanding. So people are pulling back in terms of their spending, and I think that's going to feed into the hiring numbers as we move forward.
Well, this is an important conversation to have, and some credit to you, Royce. I mean, you started talking about the mortgage renewal story before a lot of our guests did, and the possible need for rate cuts by the Bank of Canada. Just to give people a better roadmap here, and I know to a certain extent this is all guesswork, but how much might rates come down? I mean, if the overnight rate right now is at 5%, what does the Bank of Canada have to think about to have a meaningful move towards avoiding a worst-case scenario with the economy?
I think they have to end probably 2024 at around 3.5%.
Really?
And then keep cutting in 2025, because the real pain actually begins in the middle of 2025 and into 2026. 2026 is where there is a huge volume of these variable rate mortgages, which people piled into in 2021 that are renewing. And so rates are going to have to come down. We're not going back to zero, but I could see rates falling to about 2.5% in terms of the Bank of Canada's policy rate. And that'll affect mortgages in terms of pulling down 5-year interest rates as well.